Oh, hey, it's live. It's live stream Tuesday. Yeah, I must have clicked to go live a couple minutes early. So welcome all to live stream Tuesday. I got to grab my notes here. You can tell usually I try to make a grand entrance, but today's just showing up. I do have a special T-shirt for all y'all. It says, think like a proton and stay positive. Yeah, think like a proton and stay positive. Well, welcome all to a live stream Tuesday. And today, I want to kind of go into what's going on because I have to tell you, I mean, these are some of the wildest markets I've ever really experienced. And I've been in this like for 30 years. I just did my silver tier ATG digital media update. And I do this before the live stream. And so my mind was like, half on like what I'm going to say now and half on there. But in the end, I mean, it got down to one thing, which is like, I think we're about to like experience like the greatest boom for the stocks that we focus on at ATG Digital, which I call OGIC, opportunity growth, innovation, crypto. Yeah, and what I'm going to tell you about today is like why I think like that's going to be the case. And it's like many things like that people don't expect. Like it's going to be shocking in like in the beginning, and then it will just be like, of course. So, all right. Well, before I do all that, let me do all the usual things to keep the lawyers happy, which is that this live stream and the content from ATG Digital Media is not investment or financial advice. It's presented as opinion, information, engagement, and entertainment. You can see I'm taking lessons from how they do those things on TV for the drug ads, right? I mean, where they just like do it. Also, all ATG digital content may contain errors, oversights, and mistakes. Yeah, we're human beings. I mean, we just don't get everything perfectly. So, I mean, you can't like think like, oh, it's like word from God. Understand that investment operations have significant risks and lead to the loss of your principal. In other words, yeah, stuff happens. I mean, we had a stock go bankrupt. There's a stock today in diamond and gold tier that's down 45% with 40 and 50 million in cash. Yeah, I mean, wild things can happen. And so what's an investment operation? Buying, selling, stock, crypto, options. Yeah, there's risk. Stuff can go wrong. You lose money. So you should be warned of this. This is like fair. Also, I, the owners, employees, contractors, own, trade, transact in the securities that are mentioned in this video, and all content from ATG Digital Media. I also need to put down, I was like, we don't take payments from like companies to promote their stocks or anybody else. I have to put that in because I know there's like something that's been going on in the old business where some of the folks that do that apparently have been taking money from people to recommend investments. Free content, Substack, Ballman Speculating podcast, which I really have to get back to doing, like, I don't know, at least 2 a month. I'll do one this week. And obviously now I'm on YouTube right now. X is probably the social media that where like real-time stuff. Like if I see something going on, I go on there. And I've written some really long posts on what I am going to be talking about in this YouTube video. So follow me on X and read some of the stuff. And I also like took some of that and I put it into yesterday's Substack. So if you want like the longer non-TLDR version of this, check into that. And this is just a repeat of ATG Digital Media. If you want to join, subscribe, be a member, atgdigital.media. That's the actual website. All right. Okay, let's get to the matter at hand. I just want to get to my notes so I don't forget the stuff that I want to talk about. Oh, there's like something on my shirt. Sorry, I hate when, because like I can see it's like a mirror, right? I mean, I can see what you can see, and I want to look good for all of y'all. All right. So, what's the most shocking thing that really has happened in the last, since October? Like, So what launched the market? Like our stocks have done okay. There's still a lot of stocks that are like below their all-time highs. But think about like all the stocks that hit new highs since October when the Federal Reserve, in a shocking move, lays out that they have like a dot plot to lower interest rates, right? And this is just like shocking because at the time, which people have forgotten now, we were very much in like, oh my God, everything's going to go to hell in a handbasket. How high are they going to raise? What are they going to destroy? And they come out of the blue and be like, no, we're actually thinking about cutting rates. And that just it blew my mind. I mean, I'll just tell you straight up. I was like, what? There's no sign that inflation is back to 2%. And it seemed like that was like their measure, right? 2%. And then they're like, no, we're planning to cut rates. So market takes off. Some of our stocks take off, but not like in the way that, like all the chip stocks took off because like ChatGPT had been released. And I imagine that like Wall Street salespeople, they have salespeople on Wall Street. They call you up and be like, hey, do you want to talk to our analyst? Our chip analyst says like AI is going to be, that must be a sell job because all these stocks just like rocket higher. NVIDIA obviously has a couple of great quarters. And then all the bank stocks boom and all the big tech stocks boom. In other words, it's as if it's like we're going to experience like some kind of like boom. And then if you then go look now, Morgan Stanley reported today. I forget who else reported. Johnson & Johnson reported today. These are all stocks that are trading for 20, 30 times earnings. 2% growth, 3% growth. So this is like a whacked market. People kind of like, the Federal Reserve said, oh, we're going to cut interest rates. And people went and bid like all these stocks to new highs, beating out the previous peak. Real estate markets, like many of them have made new highs. In other words, the markets are set up still as if we're going to have a recession. The Fed is going to juice like the liquidity, and take interest rates to zero, go back to doing quantitative easing, everything will soar. That's not the scenario that I am seeing that is going to unfold. So what is going on with all of this? Well, recently, of course, to no shock to anybody that, well, if you're watching this YouTube channel, inflation, is baked into the cake now. And I've told you my reasoning for why, which is like very common sense, which is that if you're paying people more, well, you're going to try and get it from your customers. So prices are going to go up. If you have suppliers and they're paying people more, well, they're going to have to get it from their customers. That gets locked into contracts, that gets constant agreements, that gets locked into people's expectations of how they think about the future. Everybody's bar gets set higher, right? And the only way to really like knock it all down is to do what the Federal Reserve did in 1970s, late 1970s, which is that Paul Volcker, who was the chairman of the Federal Reserve at the time, was like, I am going to absolutely get inflation down. And he just kept lifting rates until they were at 16%, just completely destroyed the economy. At 16%, who's going to borrow money? Nobody. Who's going to buy a house? Nobody. Who's going to buy a car? Nobody. I absolutely devastated the economy, but brought inflation under control. And then from there, we enjoyed, 40 years of disinflation, deflation, all the stuff, from that. So what is our Federal Reserve with Jay Powell? Is he gonna take interest rates to 16%? Nah. There's no appetite for this. Absolutely none. No appetite for this. Companies have an extraordinary amount of debt. The U.S. government had all this debt. There's no appetite for this. So they seem to have come about to a different strategy, which is what I'm alluded to in my title, which is what the Fed's secret AI plan gambit. Okay. So let me just take all this back like a couple of steps. All right. Inflation is running hot, right? Yeah. I mean, we just had a report where the annualized rate, if you were to do it, is like 4.8%. So the idea that, like, the Federal Reserve is not out there pounding the table to say, well, no, we're going to lift rates up, we're going to get this inflation at 2%, like that by itself is kind of amazing. There, even after that number, there's still people like, hey, we're still looking to cut. We're still, so that's kind of like mind blowing. Yeah. There is no recession. Yeah, I mean, consumer spending came out like what, yesterday? Yeah, I mean, there's a guy I follow. I recommend to everybody. His name is Wolf Street. He does great macro analysis, and he calls the spending drunken sailors. And so there's category after category where, like, spending is just like, yeah, it's like asset prices at new highs. So we've got no recession. I mean, we might see a slowdown, but no recession. We have no, excuse me, pollen in North Carolina this year. This made me cough like crazy. We have no crisis. I mean, there is like some mini crises that are out there. I'll cover. There's no crash. I mean, everything's at near all-time highs, except, of course, for many of our stocks. What are the mini crises? Many small and mid-sized banks are effectively bankrupt because they put all of their deposits that came flooding in when the government send out the stimmies. They put it into long-term bonds, and then of course the Federal Reserve lifted rates, and those are down 30, 40, 50%. So they have all these unrealized losses, but it's not big enough to cause a systemic problem. Commercial real estate. Yeah, I mean, that's another mini crisis. It's a big category, but the banks, apparently 10% of their asset base, in other words, their loans, is exposed to commercial real estate, and it's mostly in smaller and mid-sized banks. Again, yeah, an issue, but no systemic risk potential like Lehman Brothers and what happened in 2008. What else? Let's see. Going through to okay, conspiracy theory, you can say, like, why would the Federal Reserve be considering interest rate cuts here? Well, if you know the history of the Federal Reserve, essentially they're owned by the banking sector. I mean, that's who staffs the Fed, that's whose fees fund the Fed. And so, yeah, I mean, those things that I mentioned earlier, the banking sector would like lower rates to get them out of the unrealized loss problem, the commercial real estate problem. So maybe that's, definitely one of the reasons why the Federal Reserve is not talking up higher interest rates, and why they are still we still want to cut. We still want to cut. Then there's, of course, politics, and it's an election year. The Fed, has to go give testimony to Congress. I forget it. I think it's every quarter. So, I mean, you've got politicians calling for lower rates. Then the president is the one who nominates the governors to the Fed. So they had to keep him happy. So, yeah, I mean, that's one reason. It's an election year, right? It's a real kind of like a toxic brew of stuff. Then there's the interest on the national debt, which is whatever, I think at 11% of the budget or something. I mean, it's obviously something that would benefit from rates being lower. And Jay Powell has come out and said okay, yeah, I'm concerned. But I think out of the box, right? Okay. And I don't really go with whatever's put out there. So those things I put out there, yeah, I mean, I think they're all reasons for it. But I've got to believe that the Fed as well is okay, well, what alternatives do we have, right? Inflation is running hot. Okay, it's not running at 17%. It's not running at 12%. It's running at between 1% and 2% higher than where they want it to be, right? They are shackled in terms of what they can do with interest rates because of the amount of debt at companies, the amount of debt at governments, because, again, the unrealized loss problem at banks, commercial real estate, and then it's an election year. They can't do much. They're facing pressure on all sides to not raise interest rates and to instead go the other way, which, yeah, I mean, could only be justified using, old school thinking, no risk in a recession or if there's a crisis or a crash. Now, and I came up with this view after seeing something that was in the minutes, which is that personally, I think the Fed is like, well, we got no real other options other than to kind of like work on something that is the only non-rate increase way to try and control inflation. And what is that? Well, if you think about this, right? I mean, think about one company and whose stock is being punished because they're cutting prices. Starts with a T, ends with an A, right? It's Tesla, right? Yeah, I mean, why is Tesla able to cut prices and still make money, by the way? Tesla is still the world's most profitable automaker, despite cutting prices in some cases by as much as 30%, right? They're cutting prices by 30%. They still make money. So is Tesla a contributor to inflation, or are they helping with inflation? Where, I mean, if you're cutting prices, you're helping with inflation. You're not charging people more, and you are gaining market share by cutting price, because despite whatever people think about Elon's politics, yeah, I mean, most people are price buyers. Yeah, you can get a Model 3 today for whatever, $22,000. It's cheaper than pretty much any internal combustion engine car. Most people are going to, vote with their wallets, and they're going to go be like, okay, I'm buying an EV. I'm going to buy a Tesla because it's cheap. And yeah, it's whatever, $4,000, $5,000, $7,000 cheaper than whatever else I might compare it to. And many young people today and generally are looking to switch over to EVs. And if they are, Tesla's the most price competitive of that. So just stick with me with this way of thinking, right? So if you're at the Fed, and they've got 650 PhDs, by the way, I couldn't believe it, right? I mean, the Fed is staffed by 650 PhDs, yeah? 650. I mean, wow. I mean, you'd fill buildings. I've got to imagine like there's some Tesla shareholders among the 650 PhDs. And there are maybe some ATG Digital Media subscribers, but whatever it is, there's probably some stock investors. Some of them are innovation driven, can see, the extraordinary change that is like just coming at it, and be like, yeah, well, what about betting on innovation? Because innovation can cut prices, right? I mean, Tesla, right? Why can Tesla do what it does? Well, because when you are a new technology and you're scaling up, the per unit cost goes down as you scale up. So the more you produce, the per unit cost goes down. And now you can cut prices and kind of like share the savings with your customers. If you're a legacy incumbent business, yeah, I mean, you've been in this business for, I don't know, whatever, 50 years, 70 years, there's no scaling. There's no savings from scaling. You're already scaled up. The benefits of scaling up were, I don't know, 50, 60 years ago when you were younger, newer, and when you represented, an innovation company, but you no longer are that. But the new companies, the innovation companies, if they can be unleashed into the marketplace, yeah, they will cut prices. They will compete on price to the extent they've got a scalable technology that whereas they scale up, yeah, the per unit cost is going down, or else that technology gives them some sort of advantage that a legacy incumbent company cannot implement because their technology stack and infrastructure is so old. It costs too much to go into. So if you implement it, like let's say, you do digital twins, if you can implement it, and now maybe it's on pilferage, maybe it's on storage, maybe it's on temperature control. You can do something that your competitor can't. Now your costs are lower. You pass some of that on. Yeah, you start taking market share. So here's what I think is going on, which is that the Fed is choosing to essentially roll the dice on the only non-rate increase way to control inflation, and that is to unleash the innovation effect on the economy. The Federal Reserve would know that its rate increases crushed the innovation sector, our stocks. Why? Because, well, investors reduce risk and long duration bets. in case you are unaware, the theory behind reducing um, or and the value of innovation assets being lesser when interest rates go up because of inflation is that the peak cash flow for a newer company is somewhere out further into the future than for a mature company. A mature company, they're not going to grow very much, but their cash flows are steady Eddie, and it's right there. But an innovation company, let's say Matterport, I brought up Digital Twins, which is a holding in our silver tier. Where is their peak cash flow? Where is, well, it's probably like 15 years out. So under the theory of duration, which is that under inflation, yeah, I mean, that money, loses value the further out in time you go. So then if you do a discounted cash flow analysis, you get to a lower number, but interest rates are high and inflation is rising. Then if, interest rates are lower, and inflation, is under control. So one of the things that the Fed can do, is if they cut rates, it has the effect of what? Increasing investor preferences for longer duration assets. In other words, growth stocks, innovation stocks, opportunity stocks. And in the Fed minutes, there's actually a reference that multiple governors reference that there are multiple technologies today that could increase productivity that would have a material effect on inflation. And they are willing to kind of let, things ride to see if this will go. And this is part of the thinking behind, at the very least, them holding inflation where it is rather than looking to, interest rates where it is rather than looking to increase it, and looking to lower it when there is no recession, no crisis, no crash. And if you are looking at our portfolio, I made a list of all the innovations that can be unleashed on the economy. Artificial intelligence. Well, I mean, this has the ability to reduce costs, everything from, various, I'm trying to think of companies like UiPath, right? I mean, this is a holding in our silver tier. I mean, essentially it automates, it's called robotic process automation. I mean, if you even think about any instruction that has to be copied, processed, there's a level of manual effort required. And if you can roboticize this, automate it, you get obviously labor savings, you get precision savings because human beings, we tend to make mistakes, and you get a productivity increase. I mean, this is a form of AI that's out there that, it has huge impact the more it's implemented through society. Is that captured in UiPath stock? Absolutely not. Is that captured in macro? No, it's not. And so this is the form of thinking that, in my opinion, works. Like autonomy. I mean, I was reading on X that Elon is like, we're going all out on robo taxis, and people are like, oh my God, what are you talking about? I mean, so I've had a Tesla since 2018. I've had full self-driving / autopilot, excuse me, whatever the program was called, through my entire six years. I'm almost exactly at my 6-year anniversary. And I can tell you the current form of what's called full self-driving is genuinely amazing. Like the original forms were quite crude, quite simple. But today we are at a point where I can press a button and it will drive me to my destination. It is not quite perfect. There are certain judgments and decisions where I would like it to do things a little bit faster, a little bit better, but it is mostly safe, has a certain number of edge situations, and it's improved. Like even in like the last 30 days, I've gotten 2 new updates, and like each update, like the things that I have issues with just keep going away, So pretty much now, whereas in previous years and versions, I would never literally be able to do what I do, which is press a button and have the car drive me to my destination. I do that now every day. How good will this be in 3 months? How good will this be in 6 months? How good will this be in 12 months, 24 months, 36 months? Yeah, from a personal user, from someone that actually uses it, I'm going to say this is going to be amazing. And it is going to change the world. And right now, Tesla stock is acting like, autonomy, schmautonomy. Who cares? Yeah, I mean, this is going to be a big deal. Why? Well, I mean, transportation is a big issue. A robo-taxi increases the utility of any car that has the ability to drive you someplace increases its utility. You can now start to get in and go to places for much cheaper than you could. I mean, so this will absolutely change the cost structure of transportation. Does that increase or lower prices? Does that increase inflation or reduce it? Yeah, I mean, the cost, I think, per mile for a car today that doesn't have autonomy is something like 40 cents or something like that per mile. With autonomy, it's 4 to 6 cents. Now, I know many people say, Paul, it's not going to happen. It's sci-fi. Elon's been talking about this. Look, folks, I experience it. We're not quite there yet. It's not perfect, but it is improving at a rate that is extraordinary now because they are now using a neural network with AI. In other words, drive like a human. What would a human do? Human judgment. And then, yeah, I mean, once this happens, I mean, like, yeah, the demand for cars in like cities is just going to go to zero. Nobody's going to want to own a car if you can have a robo taxi. I mean, not nobody. Some people will prefer it. Kind of like, people kept horses after cars came. It'll be a very deliberate choice to have a car because there would be no real practical logistical need to have one. That will upend, obviously, the auto market in a big way. But in general, it would upend not just the auto market, but the transportation market. And again, think through the implications, which is like, I believe something like 60% of all of the revenue that airlines get comes from short haul flights. So in other words, like, for example, I am going to go visit my mother in India in May, and I just booked a ticket to Washington, D.C., $600. Yeah, I mean, $600, right? For that, like, what's about a 6 hour, between a 4 and 6 hour drive, depending on traffic. What I have to get up at something like 4 in the morning, go take a car to the airport, go through security, get on the plane, get off the plane. Yeah, I mean, I'm going to be taking another flight from there, so I won't have to take, an Uber or a taxi back into Washington D.C. But it's going to upend the economics of a lot of regional transport because I would definitely, in a comfortable car with the car driving me, it's not going to cost $600. It's not going to cost $500. It's not going to cost $300. It will probably cost probably like $80, $90 for me to get into a car and go to Washington, D.C. maximum. Why? Because, well, I mean, there's no person driving it. It's a machine that drives itself. You're just there. And many people say, Paul, I would never trust it. That's all fine. I mean, when you get on a plane, 90% of the time, the plane is being operated by a computer. So, I mean, you may think that this is very unusual. This is like some weird, but there are lots of machines today that, are run by lots of things today that are run by computers you're unaware of. And this will be something that, I mean, we'll see, like, we already have robo taxis in San Francisco. I forget where there's, where else would we have them, but definitely in San Francisco. And they'll come. And with that, you again, will prices go down or up? Well, the cost of transportation will plummet. I'll absolutely plummet. So this idea that innovation is the best bet that we have to control inflation. Yeah, I mean, I think this is the idea that is kind of driving at least some of what the Fed is thinking, because otherwise there's nothing. I mean, every inflation report that's come, has been hot. Wages are rising. Consumer spending is high. There is simply zero sign that the Federal Reserve's huge increase from 0 to 5.25% has changed really anything. I mean, we had a quarter or two of marginally negative growth. We had a quarter or two where it looked like, maybe prices would, come down as a result of people being like, okay, I'm going to save my money because 5% is a really high rate. Yeah, that ended quickly. And then we've never been anywhere near the other ways by which you get prices down, which is what you essentially cause economic activity to cease. Yeah, I mean, you raise interest rates to 12, 14%, no houses will sell, no cars will sell, there will be no business loans made. Yeah, you will essentially a flat earth economy. So the Federal Reserve is not going to do that, but it wants lower inflation. And the one thing that it will know from probably its 650 PhDs, knowing is that when it had very low interest rates, it, without intending to, seeded this innovation economy. Because from 2008 all the way till 2021, when we had ZIRP, LERP, ZIRP, zero interest, LERP is low interest, very low, I mean, much lower than the markets. And it did that by essentially, buying up all the non-risk assets and forcing everybody into riskier assets. It kind of like seeded this innovation economy. Hundreds, if not thousands of companies and ideas were seeded. And now, after 3 years of them being vetted by like these 5.525% rates, by stocks being smashed, the companies themselves being like, okay, like we got to get real. They pivoted to like, hey, we need to produce a profit. We need to be self-sustaining. So they've cut costs. They have like chopped off their like, wacko programs that were never, ever going to be real businesses. So the innovation companies today sit perfectly. They are in control of unique, different, scalable technologies that work. We need them to work for a number of reasons. Obviously, inflation is one, but inflation is driven by something, that's more basic, which is a labor shortage, which is what's driving up wages. So there's often no alternative that's there. And the companies today, after 3 years of like, companies have cut a lot. I mean, it's not talked about because everyone, the media's focus, even on social media, is on very large companies. But these smaller companies have cut 20, 30% of like their cost structure. And they have gotten, it's like, hey, we're going to focus on this one product. Why? Well, because that's where our customers are. And we clearly provide a utility, a use. I mean, the market's going to come back from where it is, where they have bid up everything like, that is not this. I mean, J&J is at 35 times earnings with 3% growth. I mean, that's insane. The banking sector with its all losses, all trades for like 20, 25. So, I mean, that's based on like all kinds of thinking that was driven originally from the idea that, well, if the Federal Reserve lifts interest rates by 5%, we're going to have a recession. It's going to be huge. There's going to be a crisis like the global financial crisis from 2008. Or at the very least, there'll be like a crash in real estate as people stop by. And none of that happened. But the markets are set up as if it's still going to happen. And the trigger for this like unwinding is going to be, the Federal Reserve doing now the unthinkable. Like you would never think that with inflation where it is that they would cut rates, but they are clearly and regularly transmitting like we are itching, looking for any excuse to cut rates. And you know what? That's great for us. Why? Because the bets that have been made that exist today, which are the big tech stocks, the dividend stocks, the safety stability stocks, the big stocks in general, which is where you would huddle if you're worried and, like, oh, that's going to unwind. And why? Risk-taking will rise. Money will push into innovation stocks, smaller stocks, mid stocks, companies with growth in front of it. And hey, this YouTube live stream is not investment or financial advice, but we are setting up for a 5 to 7 year incredible run. Every big run is driven by some macro thing that helps you. In this case, the structure of the markets where everybody's on one side of the market, that's one element. Interest rates going down when nobody could imagine it. Nobody is anticipating it. So they're all on the other side. You've got the fundamentals of the stock companies where there's growth, they're in good shape, they're growing, they provide some utility. The future benefits are not discounted into the stock price. And then like the basic psychologists, people are not expecting it, so they're not in these prices, and that's where you get big bull markets. That's where you get big gains, and it looks like we're setting up for a big run because once they cut, money comes in, the focus of the market will shift. I mean, just remember, like we were focused on technology and all these things. Like literally in 2021, everybody, in the middle of COVID was talking about, all the technology and how, we had fast forward into the future. But today markets are set up as if we're going to go back to 1990. But we're, in my judgment, in my opinion, we're at a moment where like the fast forward is about, like we're about to hit the fast forward button again. I'll move forward, and where, yeah, AI, autonomy. Go back to my list here. What are the other ones? Because I got new energy. I mean, yeah, I mean, people are focused on oil, but like, I mean, battery installations hit a record high in 2023. We are clearly, now well into like past the beginning stage of the transition from legacy energy onto solar, wind, battery power, biotech and genetics. I've talked about all this. Telemedicine. I mean, we don't have enough doctors. We don't have enough nurses. We have to somehow utilize our existing infrastructure in a better way. And you can be like, well, I can wait 6 months for an appointment. I can pay $5,000, or you can start to implement technology that is ready. One of the things that the recent attack by Iran on Israel did is like show you the power of drones, which kind of like people have been forgotten about. And I was like, yeah. I mean, I was doing work over the weekend as this attack was unfolding, and I was like, yeah, that's a signal. Yeah, I mean, we don't think about drones, but this is another transportation reality that is mostly not priced into these stocks. So we added a stock into the gold tier, we added a stock into the diamond tier that do drones. 3D printing, yeah, I mean, people say, oh, Paul, you've been talking about this forever. Hey, all fair. But you know what? You can't be in a technology and have a negative point of view. I can see what 3D printing does, and like, yeah, can we use 3D printing to cut the costs of like, or the dependence on other countries, make things here? It would, yeah, generate its own sort of like, new supplier economy where we start to make things ourselves. So the world's about to change, in my judgment, my opinion, and is in our favor. I mean, we have not had the macro in our favor for the better part of 3 years. The moment the Federal Reserve started to raise interest rates, a lot of investors could argue, oh, long duration assets, inflation, this, that, and the other. But we've got things now where, yeah, things are in our favor. The Federal Reserve, even in this environment, is saying we want to cut. And the cut is expected to be 1.5%. So we're at 5.25% in terms of the Fed funds rate. So 1.5% is like what? So 4.25. Yeah, I mean, we're talking about like 3.75%, something 3.5%. 3.5% is obviously a lot higher than zero, but it is not high in the historical context of interest rates. Growth stocks, innovation, yeah, it can absolutely boom in that environment. And they will have much higher growth rates in that environment. So that fundamental case, is there with macro support. The other one is the mechanics of the market, right? Now, we're all very psychologically inclined to want high prices, and I get it, but those are gains, right? I mean, unless you sell out at the high price, you don't make a profit, right? I mean, these are, the prices are simply like there from day to day, and obviously our emotions ride up and down. As someone takes a high price, accepts a low price, it swings up and down. I'm hoping that there's somebody at my door, and I'm hoping that they actually don't need a signature. But it looks like they delivered it, so that should be okay. This is the downside of live streaming, but um, the the other part that's in our favor is that. All right, I'm gonna have to like take a break for a second and sign. I'll be right back. Sorry, package came and they kept ringing the bell, so I had to go. Otherwise, I'd have to just have the bell ringing all the time. That was the easier option. Um, but market makers are the ones that buy, the buyers of last resort, when nobody wants to own an asset, right? At low prices, retail, professional investors, being that so many of them compete on returns to keep investors' money, they want to sell. They want to sell, and they want to be in the rising asset. So who takes that liquidity risk on? Who takes that inventory on? Who holds the low priced merchandise? Well, for the most part, it's market makers, it's investment banks, it's someone that doesn't have the same sort of like competitive pressures. If you're a hedge fund, you got to deliver annual performance or you lose your clients. Mutual funds, same thing. Most individual investors, when we see the price of something being marked down, being pushed down, what's our inclination? We don't see it as we don't see it as low prices. We see it as going down and losing money, bag holder. There's all of these psychological terms. So yeah, I mean, we're always sellers at low prices. And then what we want to do is experience rising prices, right? So people, essentially want somebody else to hold on to when prices are low, to sit through that period, and then we want to come in when the prices start to rise so we can see gains in our accounts. And Wall Street, yeah, totally gets that. They're not going to gift you high returns without them themselves making money. Because remember, anytime you sell, there's not magically a buyer that wants to buy at some low price. Like I was looking at the stock that is down 45% today. Who's buying today? I mean, it's a straight down markdown of 50%. Who's buying today? Yeah, I mean, most individual investors are not really looking to buy at this price. So there's a market maker. There's an institute. There's a large investment bank. They'll be like, sure, you want out of your position? Sure, 50% haircut. We'll take it. When will somebody want that? Well, when the company says, oh yeah, hey, earnings are going to be great, sales are going to be great, and now there's no way we'll sell for I think it's like $1.30 today. It's a company that has valuable technology. They'll mark that inventory and merchandise up and sell it to you, and then when things are good, they can show buy orders to the market, which gets the market excited, and market will help bid it up. Now this will ride back to new highs. So who owns all of our stocks after 3 years of a bear market and low prices? Well, yeah, it's market makers. So somewhere in the next, I'd say second half of 2024, the stars are aligned. Yeah, macros in our favor. Yeah, the middle people, the intermediaries, the market makers, they're in our favor, and the fundamentals, the businesses are all in our favor. So I'm expecting a very, very, very big run, a historic run that takes not all of our stocks. Some of our stocks, obviously, have problems, and they're gonna, we've sold many of them, but many of our stocks that have real businesses that have done the work to cut costs, focus on the projects that are profitable, they're going to go back to their old highs, and then they're going to make new highs for years to come. So that's like really, what I've got this week on the live stream. You can go through the previous live streams and see I've recommended a lot of stocks, a lot of crypto. Those would be the places to go to. Obviously, biotech, genetics, new energy, fintech, crypto, There's the digital stocks, like, that I've mentioned, everything from, Wayfair, Trade Desk. Either way, or if you're a subscriber, Silver Tier will give you a good sampling of that. And with that, let me start to take some questions. I see some comments here. Let me start here. Let's see. Sal says, woohoo. Well, thanks, Sal. We appreciate the enthusiastic support for the live stream. Yadira also enthusiastically says, haha, yes. Todd Cooper says, thanks for your videos, Paul. Any updated thoughts on what? WATT is the stock that I made a YouTube video on. It is Energous Corp. And Energous does something. Yeah, I mean, I dream of a day of not looking out. Maybe I can show you what's out the window and not seeing. Can you? Yeah, it's too much. Yeah, you see those wires? Yeah, I dream of a day when my children don't have to see wires because we have infrastructure from like what 1900. That's when we created the electricity infrastructure, which literally from the power plant we strung like power lines out, and that's like just continued and continued. What does Energous do? Well, it does wireless electricity. Is there an update? There's no real particular update. There's not. I cannot point to like a single client. There's like, okay, there's going to be some big explosion. Nonetheless, my view is that it's a valuable technology. It is a highly useful technology in a world that's going more and more electric. That is the energy form of new energy. And so maybe somebody buys them. Maybe they are able to roll out their technology to some small way. That is in our diamond tier. It's obviously highly speculative because they don't really have an active ongoing business that is producing a lot of cash flow, but it is a valuable technology. Okay. Next one is Raul says, hi, Paul. Thanks for your insights. Thoughts on this little correction? Are we in a correction? April is just bad. I think it's actually a transition, which is like from October till, I think probably Friday, was, well, at least in terms of the index might have been like the peak. And now, I mean, if you just think like, I mean, how did the S&P 500 make new highs without Apple hitting new highs? Like that's like, pretty weird. So that will tell you that there's a transition underway where there are stocks percolating that are smaller, mid-size underneath in many of these sectors that are getting bid up. There's short covering going on as this transition from like, oh, the Fed is planning to cut. We were prepared for a recession. We were prepared for a crisis, prepared for a crash. Now we're going to have a period where, oh, we want more risk. We want more growth. And so that transition is not going to be perfect. There's going to be, some movement within the indices that goes on. And on some days when there's bigger selling from some of these, like, where everybody is crowded on one side of the boat, when they want to sell all that, we'll have some days when people are like, oh my God, the market's about to fall out. And then look for the days when the market's doing very little, but like you'll see a lot of small stocks just like being bid up. Yeah, that's the sign that this is like, unfolding and underway. So my personal expectation is that if you're betting on the S&P 500, the NASDAQ 100, you're in for some years of stagnation. I think it is the stocks within there that are much smaller that are going to take some time to lift their weight in the index. They have to get big enough to start to move them higher. I think it's going to be a stagnant time for the quote unquote, the things that like the big indices that people call the market. I think you want to be inside those things and look at the smaller stocks there, because those are the things that have the qualities that I'm referring to. David Matthias says, wouldn't higher interest rates be better for banks? The caveat being the banks need to be reasonably well run. If you remember, when the Federal Reserve started raising interest rates, there were people that claimed this, that higher interest rates were better for banks. Yeah, I mean, higher interest rates were terrible for banks because they took deposit money that they were flushed with in 2020 and 2021 and bought what? They bought like 10 and 30-year treasuries, which they're down 40% on. So not good for their reserves. Second, after 14 years or so of low interest rates, they've gotten used to paying nothing on deposits. Like even today, my Wells Fargo account pays me 1.1%. I think Fidelity offers me a more competitive return on money markets. So they have not repriced their deposits, and so as a result, deposits are fleeing banks. And that's like in my one of my expos, I have the amount. I mean, like money is just absolutely like leaving the banks and going to money market funds. Then you take the third thing, which is like, well, your reserves are been are down. Your deposits are fleeing. How are you making loans? And if you don't make loans, how are you making money? Then you've got the commercial real estate problem. So yeah, this idea that like higher interest rates are better for banks is not based on any kind of fact process. David says the plugged-in banks are even more profitable when programs like QE and BTFP run, since they can simply pocket the spread. The Fed is, yeah, I mean, that spread has been long been wiped out. BTFP essentially has been shut down and it's over. And the Fed has been in quantitative tightening mode for more than 2 years now. So these are all past-based analysis. So now it does not reflect the reality today. Rashad says the video came just in time. I know you can't provide financial advice. But what percent would you recommend Tesla be in a portfolio? Well, I always tell, what we always have said for our portfolio is an equal weight. I mean, everybody wants to make one big giant killing, but that is like not a not a way that I've ever told people to go about investing or speculating. I've always said equal weight, because you don't know which stock is going to be a dud. You don't know which is going to be a loser. But you don't know which one is going to go up the most, and we don't know which one's going to go up the fastest. So have a portfolio, and if you equal weight, then if you're doing a stock portfolio of 10, then you'd put 10% in it, and over time, what will happen is that Tesla will become a larger and larger weight, and you just let that be. You put a 10% at cost is what I have always guided to. Anthony says, "Hey Paul, I look forward to these videos each week. Thoughts on Tesla FSD 99 per month, subscription layoffs, Cybertruck halts?" Yeah, I mean, I think the FSD 99 is another play for market share and exposure of an amazing technology that only they have. So $99 reduces a friction point where Tesla will produce probably 1.5 million, 2 million cars. I think it's at this point, it's something like 15% of cars subscribe to FSD. $99 would move that penetration rate to much higher. This is, I mean, software is the highest margin revenue that you can generate across a large number of cars. It would increase the amount of revenue in a significant pattern. Layoffs, I mean, Elon's always done, I don't know, some number of layoffs at any pivotal turning point, with sales, being hit by higher interest rates and them cutting prices, with a shift again to like, okay, FSD is ready, robo-taxis are a natural progression. You would reorient the organization for what talent and skills you need. They've, like just like Amazon is always churning based on what the opportunity set that is in front of them. This is not unusual or anything different than what Elon and Tesla have done in the past. And Cybertruck halts, I'm not quite sure what the Cybertruck halts are reference to. I mean, they're still in the very early stages of scaling up production. I think they're at a run rate of like 500 a day, something in that range, 500,000 a day. So it's too early. I mean, remember the production issues with Model 3? I mean, they had to build a tent because they had like over roboticized the production process. So I mean, we're in what, like month 5 or 6 of the production. If there's a halt, then, I mean, it's completely normal. I mean, you're trying to scale something up from zero to trying to produce hundreds of thousands of trucks per day. I mean, you're going to have some issues. Excuse me. John must be LOLing at the fact that I had to go get the delivery. Reality of being, I guess, a streamer, you got to deal with things that are going on. Liz says, "Have a day." Hey, Liz, always love the support that you bring. Great spirit. Thank you. And you do remind me of something, which is that the Bitcoin halving is coming. We are only about 500 computing blocks away before getting to block 840,000, which is the halving mark. Based on an average of 10 minutes per block, it is set for the 19th or the 20th, or maybe, somewhere in there, depending on how long each block takes. And yeah, I mean, this is going to be, another thing that kind of like accentuates the point that I'm making, which is that crypto is very much part of the OGI sector, opportunity, growth, innovation. It is digital money, it's a digital store of value, digital gold. The supply of this very valuable and scarce and like provably scarce, provably finite asset, the new supply is about to be cut in half. Just as we have an ETF, ETFs, we have 9 ETFs in the United States that have taken in about $12 billion. We got, I think, an ETF that was just approved in Hong Kong. Singapore plans its own ETF. I imagine that other countries will do the same. So the demand response, everything points to a pipeline of like increasing demand into a programmed and known supply shock. And every previous halving has generated a price response as a result of the supply shock. So I mean, I did my video on this, and there's been, I think the last halving was like the lowest at 700%. But this halving, I mean, with global demand coming at like so little additional new supply. I mean, if we go from 900 Bitcoin being produced by miners a day to 450, right? Meanwhile, the accessible demand, the access to Bitcoin has jumped by, I don't know, what's the right number? I mean, before, if you didn't want to buy Bitcoin, didn't want to open up a Coinbase account, didn't want to have, your money on Cash App or on Venmo, what alternative did you have? Well, GBTC, which could trade at some crazy premium, could trade at some crazy discount. Yeah, I mean, and it traded on the over-the-counter market. Today, you can go leave your money at BlackRock and have them custody your Bitcoin for you. I mean, BlackRock is almost as big as GBTC today. So then you got Hong Kong, Singapore. These are some of the biggest financial centers in the world. Asian money flows through there. Yeah, I mean, and now you've got the halving coming in, 3 days, right? Now, I would have imagined that, like, the halving would probably be at $80,000, and maybe, I don't know, the price will jump between now and then. But either way, whatever it is, it's basic fundamental economics, right? If you have the supply of something get cut by half, the new supply of something cut by half, right? And the demand, let's say, stays the same, you tend to get a price increase, right? I mean, in other words, reduced supply, demand being the same. It's not likely that demand is going to go down post-halving. It's, at the very least going to stay the same. Now, when you get the price response as a result of that demand meeting far less supply, the nature of human psychology is that we want gains, right? We want to be in rising prices. So that stimulates demand. That demand comes and start to bid prices even higher, which stimulates demand. And now you're in this like virtuous circle of price gains where, that's what's happened in previous halving, except in this case, we've got the world of asset management I think total number of assets in the world is 600 trillion. So what? 10% of 600 trillion would be 60 trillion. 1% would be 6 trillion. This is a $1.3 trillion asset with 21 million finite supply, where the supply is going to be cut. Yeah, let's see. Like as I like to say, when the odds are good, you should be in those things. So I am incredibly bullish, obviously, for the scenario, for our stocks, for Bitcoin, and that will obviously drive sentiment as well, both for crypto, which will then push into the stock market, for fintech and crypto. So I like how things are going. Rashad said, are you going to be live streaming on the halving day? Yeah, I mean, I'm definitely, B and Dean and the team have come up with t-shirts for halving, which maybe they'll put out in the Substack. I'll be wearing our halving t-shirt. And if it is like at a reasonable hour, maybe we'll even have like a block 840,000 halving stream. But I will definitely be having, so, I'll put up the event once it becomes clear when it's going to be, so that, we're on around that time, unless it's obviously at 2 a.m. or something like that. And I'm not going to do that. And then, maybe we'll do it just like a few hours before. Leah Sim says, when I first subscribed to Profits Unlimited, you recommended profitable growth stocks with catalysts. Now it's macro speculation, market make it theories, and money losing Kathy Wood hype stocks. Why the change? That is not true. We recommended all kinds of stocks in a 0% interest rate environment. What you were getting is the stock market being willing to price assets what it is. If you want pure, value-based stocks, I've never done that. When we recommended ST Microelectronics, they were losing money hand over fist because they were at the cyclical low. So I focus on trying to make big money over time. And I've always been focused on psychology. I've always been focused on mechanics because I've been personally exposed to it. And people who don't want that, there's my old Bain and Hill is there. You go there, they'll do what you want, I'm sure. John says, "Hey Paul, hearing rumors of possible hike versus cut." Yeah, I would say, the Federal Reserve has had plenty of opportunity to reverse their dot plot of the cut. And despite inflation coming in hot multiple times, they have chosen to continue to say, hey, we're still looking to cut. We're still looking to cut. We're still looking to cut. So just like, when they flipped, right, from like, hey, we're not planning to raise interest rates for the foreseeable future to, oh my God, inflation's out of control, we're going to raise. In that scenario, yeah, once they made a commitment that they were going to raise, they kept raising. So back then, the expectation was that they weren't going to raise. Just like now, the expectation is like, oh, they might not cut. But they're saying like, hey, we want to cut. We're looking for a reason to cut. We're looking for an excuse to cut. I think they're going to cut. And just like in hindsight, if you knew that they were going to take interest rates from 0 to 5%, yeah, I probably would have sold more of our portfolio down, but I had no expectation that they would take interest rates from 0 to 5%. So you've got now, them walking backwards. Yeah, maybe they cut by 2%. And if they do, what will it do to our stocks? Yeah, I think it'll rocket them higher. So the market isn't set up for that. We are set up for that. And so I'm bullish. I'm optimistic. I'm positive for what can unfold for us. I'm seeing no more questions. David says, don't forget to like and subscribe. Yeah, please. I appreciate that. Also, if you're looking for subscriptions, that's ATG Digital Media. Follow me on X or Instagram. We're marginally active. Facebook, I'm going to do a Facebook Live just to update folks on there. You can join me there. And then, of course, our Substack. Thank you all for attending this live stream. Always appreciate your support. And we'll be doing a halving live stream. I will put it up on the channel once it becomes closer probably on the 18th. I think by the 18th, we'll know for sure around when it's going to be. So unless it's going to be like very like, early morning, but if it's during like business hours, etc., you bet I'm going to be on, and we'll also get Dean on, and we'll get Dan on as well, and we'll have like a little bit of like a team live stream to talk about the halving and just have a general chat about investments and crypto. Thank you everyone for joining me this live stream. Come back again next Tuesday for Live Stream Tuesday. Thank you everyone. Bye. See you soon.